Today we had a conference 5 years on from Lehman's, and obviously the question that was uppermost in people's mind is, have we made any progress? Has any progress been made? And I think the views were not unanimous. In fact, the majority view was that far too little progress has been made. On the other hand, some progress has been made. The regulators have made some progress, obviously, in increasing the amount of capital that banks have to hold. Banking managements, I think, have become forced to look at risks in a far more holistic way. There have been regulators who have set a different kind of structure for banking. For example, the Liikanen proposals for the European Commission, and obviously the Vickers proposals here, the ring fencing, as we call it. So some progress has been made, but I'd have to say that the majority view was that not enough progress has been made, even if some progress has been made. My own view is that quite a lot of progress has been made. I'll look at the positives on governance of banks, i.e. The boards of banks are composed more now than they have been in the past of outside directors who really do understand banking. I think bank boards in the past have been composed of very eminent people, but who didn't necessarily understand banking. I put forward the proposal that perhaps 50% of the outside directors on bank boards should be people who are very knowledgeable about the domain, the sector, the banking itself, so that they can truly question and interact critically the management. Management obviously is supposed to understand about banking, but you don't want all boards of banks to be composed solely of bankers. That's then you get groupthink. That wouldn't be the right thing. So progress has been made there. I personally think that progress has been made in relation to the safety of banks. Perhaps not enough. There was a view that more capital was needed. I would not necessarily agree with that, but certainly more capital than we had. I'd agree with, and that has taken place, 10%, for example. The ring fencing and so on. But there are probably more things to be done. There is also the other view, and that is that if you do this too quickly, perhaps you impair the growth of a rather fragile economy, and perhaps we ought to think of some of these things, but this is not necessarily the best time to do it. The new regulation so far is fine, and it's a question of how much further do they need to go, and this is where I would question, why don't we actually see how these things are going? They're not life-threatening to the financial system, I believe, what we've got. They may not be perfect, they may not be the best, but quite a lot has been done, and I would watch it very carefully, make bank boards and bank managements more responsible perhaps than they have been, have the regulators take perhaps better judgments, look at the macroeconomic picture rather than just the trees, look at the wood and the knock-on effect. For example, I think people underestimated the fact that they looked at the secondary effect, that if I owe money to somebody, or if my bank owes money to another bank and I can't repay, that's one thing that affects that other bank. No, it affects all kinds of other banks, because if that bank gets itself in trouble because I can't repay, the tertiary effect, and I think people hadn't, and I think the stress testing, tertiary effect, all these kind of things are taken very much more seriously. So I think for the time being, certainly let's see whether this is enough or whether something more needs to be done. If something more needs to be done, I think it's probably, in my view, much more tinkering around the edges rather than a wholesale change again.